Hello, everyone. Thank you so much for joining me. My name is Fawad Razaqzada, market analyst with Think Markets. In today's webinar, we will be discussing some key technical levels on the major currency pairs, on commodities like gold and silver. And if we have time, we'll cover some indices as well. Please keep this webinar as interactive as possible. So feel free to ask me questions at any time. Now, before we begin, please have a quick read through the risk warning. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. A recording of this webinar will be available on YouTube, so you can watch it at a later time. But please do make sure that, please do keep in mind that the markets will have moved by the time you hear this on or watch this on YouTube. Anyway, please, as I mentioned, keep your questions coming. I will answer any market-related questions you have at any time. Okay, so without further ado, I am going to talk about the charts. Before I do that, actually, let me just quickly remind you of the agenda. First of all, I forgot to wish you a happy new year. I can't believe it, but it's 2021 already, and thank God 2020 is over. But it feels like it's more of the same, isn't it, in this year with the lockdowns in the UK being extended again. But anyway, it is what it is. Hopefully, with the developments of vaccines soon, things will return to normal or close to normal. And I look forward to those times, and I'm sure you are as well. Now, in terms of the agenda for this webinar, it happens every Tuesday at 11:30 London time. We talk about technical analysis on major currency pairs and indices and so on. We touch on fundamentals briefly, but it's mainly technically focused webinar. So I'm going to start off with the chart of dollar index, and the new year started with the dollar going down, continuing its recent trend, its recent bearish trend, with the currency, with the reserve currency coming under pressure against all major currencies, really, especially the likes of the Aussie, the Kiwi, those risk-sensitive currencies, because investors are looking forward to more normal times ahead and are bidding up prices or the exchange rates of the Aussie dollar, New Zealand dollar, even the Canadian dollar has been performing really well against the US dollar. But we've also been seeing good performance from the likes of the euro, the pound, mainly because of hopes. Before it was hopes, now it's reality that a no-deal Brexit could be avoided. And of course, just before the end of the year, the UK government finally agreed with the European Union to exit the union with a deal, which means that there will not be any tariffs on trades between the two trading blocks. So that was good news, and the pound initially reacted positively to the news. It had the 127.2 extension of the recent downswing, which is drawn here. It had the 127.2 extension, and then the news of the lockdown, the latest lockdowns were announced, and then that caused the pound to go down. Nonetheless, the pound has held its own above this key support area in this region at around 135 area, which was previously a key resistance level, as you can see on this daily chart. For as long as the pound remains around that level, the path of least resistance remains to the upside. Okay, so it's normal for markets to come down. Things don't go normally in one straight line. So even though we do have the Brexit agreement, it doesn't necessarily mean the pound is going to go to 140 or 150 in a straight line. It will most likely get to 140 in my view, but it will do so in the normal way the market rises, making higher highs and higher lows. So unless something really significant changes, I think the path of least resistance for the pound dollar would be to the upside. And as the pound continues to print bullish price action, this should, in theory, weigh on the dollar index. So let me go back to the dollar index here. And the dollar index, it's kind of bleeding lower, and you have to look at historical prices to figure out where it might head down to next. And the next logical level for me is the 2018 low marked here at 88.25-ish. So I think that's where the next downside objective is for the bears for the dollar index. So I think it will get there, and if it gets there, it means that well, for it to get there, the pound, the euro, the yen all have to continue their recent bullish momentum. So I touched on the pound. It's really kind of simple in a way, because yes, we do have the latest lockdowns hurting the economic recovery, but I think given what's happened with the Brexit deal, there were people pricing in a no deal exit at the back end of last year, which caused the pound to kind of struggle around the 135 handle. Now those people are likely to remove those bets that the pound is going to drop because of a no deal exit. And so over time, I think that the buying pressure is going to increase on this exchange rate, and rates are thus likely to push higher for that reason. So I think it's a bullish market we're looking at, not just from a technical point of view, but from a fundamental perspective as well. That being said, you always have to be prepared for the market to do something unexpected. So I will maintain my bullish bias for as long as rates hold above 135 handle. And if we go below that, then that would be the first kind of bearish sign, right? But ultimately, we do need a lower low. Now, the most recent low comes in at 131.88, this low right here. For as long as it remains above that low, the path of least resistance should be to the upside. But if that low were to break down at some point, then at that point, you'd have to drop your bullish bias, regardless of the fundamental situation. So that's the line in the sand for me. But as I said, I continue to expect higher price, higher levels for this currency pair. And the next logical objective, well, the first initial target for me from here is the liquidity now resting above Monday's bearish looking candle. So a lot of people will have seen that candle and think that this has topped out without paying respect to the longer term trend, which is bullish. So people shorting on the back of this will have placed their stops, or some of those people will have placed their stops above the high of that candle, which means therefore that if and when the trend continues to, if and when the bullish trend resumes, that is where price is highly likely to go to next, the resting stop orders above Monday's high. So that would be my first kind of upside objective at 137-ish. And then thereafter, you'd have to look at the round handles like 138, 139, but ultimately 140 is my main objective, because that's the next big psychological level. And also it is the 161.8 extension, or roughly the 161.8 extension of this last downswing here. So those two technical factors converge around the 140 handle. Also, if you zoom out a little bit and look at the historical charts, and this is a weekly chart. Let's go to the monthly, okay? This is the monthly chart, and these arrows, by the way, they were drawn on this chart before the Brexit deal happened. I said then that if a no deal exit happens, the pound could drop significantly, because investors were already pricing in a Brexit deal, which meant therefore that when the deal was announced, that we could see only a limited upside potential compared to how much it could have fallen in the event of a no deal exit. Well, as it turned out, we have a deal. So I'm going to delete these arrows now because they're no longer relevant. But I do think that, as I mentioned earlier, 140 is the next level that the pound is going to head towards next. Now, on this time frame, you can see that the pound has taken out this long-term bearish trend line, which is significantly bullish, right? And price has already created a good bullish looking structure below this bearish trend line that strongly suggested that rates were going to break higher. What I'm talking about is this fake out here around the 120 handle. You can see that this area had been support, and we then had a massive drop below it before rates recovered really sharply, and then it never looked back really. Now we've broken above the high of that last, the high that was created prior to the last drop. The fact that we've broken above that high now means that we have a higher high in place on this time frame. So that level was at 135. Now we have a higher high above that high, which means therefore that the path of least resistance on this time frame as well is to the upside. So 140 is important because this level was, as you can see right here, it was where the pound was roughly trading around in 2016 before the referendum. And everyone was expecting the UK citizens to vote in favor of the UK remaining in the EU. But as it turned out, obviously, people got wrong-footed. It was a people voted for a Brexit. And what happened since, rates broke down sharply and spent several years struggling to come back up towards that 140 area. It got here in 2018, but failed to go higher, and then it resumed lower. So I think, given how important this level is from a historical point of view, I think that's where it's going to get to next, and test that level to see, what's the demand or the supply there, and what happens when it gets there. If it gets there, could determine the near-term direction. So if we, for example, break above 140, if we get there and consolidate for a while and then break above it, then that would strongly suggest that this thing could literally go significantly higher from there, maybe 150, even 160, who knows. But if it gets to 140 and it's rejected once again with a bearish looking candle on one of the major charts, then at that point you'd think that maybe rates have reached a high, and from there we could see a retracement back down to 135. Who knows? But 140 is the objective for me, the near-term objective for me from a bullish point of view. And as things stand, there's no reason for me to be bearish on this market, because, as you can see, there's a bullish structure in place, and until and unless that breaks, I would be looking to buy the dips rather than sell the rallies. Likewise for the euro has been making higher highs and higher lows as the US dollar has been falling. Again, there's no reason for me to turn bearish on this market yet, because we haven't seen any reversal signals. And this daily chart looks a little bit messy at the moment, but essentially what I have here is a few Fibonacci extension levels, which I'm going to delete. Previously we had this bull flag pattern. We broke out above that. We formed another one here, which we talked about previously, broke above it, and we've held above it, suggesting that rates are continuing to go higher. I have marked 125 as a key level because I think that's where the euro dollar is headed to next. And the reason for that is, if I go to the monthly chart, you can see that in 2017, the euro dollar rallied sharply, then it consolidated for a while here before extending its gains. This time it's showing a similar picture. In 2000, from March 2020, it staged a sharp rally. It then went into a period of consolidation before breaking out again. So I think price is doing what it did here, and if history were to repeat itself, then as a minimum it would get to just above 125, and take out the high from 2018 at 125.55, which was head here. But like the pound, the euro has also broken its long-term bearish trend line. So this is significant, right? In addition, it has made a higher low here compared to this low, which in turn was a higher low compared to this low. So the euro dollar has been making higher lows, and soon it could make a higher high above this 2018 high. So yeah, as I mentioned, unless something changes For example, we get a clean break below 120, below this bullish trend line. There's really not much things to talk about in terms of, from a bearish perspective. I have mentioned there's a potential resistance level at 122, and for some time the euro dollar did struggle there. And the reason I had marked that level out is because of this. If you go to your left-hand side and you see this area of consolidation that happened in early 2018, 122 was where the breakdown happened. So that's why I had marked that level out as a potential area of resistance. And now that we are trying to break above that level, I don't think this level is very relevant anymore. But we do still need to create a new high above the high of 2018 to completely nullify the bearish argument, if that makes sense. Let's go to the chart of the dollar yen. And the dollar yen has been really frustrating from both a bullish and bearish point of view. From a bullish point of view, it's been frustrating because despite the ongoing risk rally, the dollar yen, which tends to track risk assets like the S&P 500 closely, it has struggled to do that, right? So every time it tried to rally, for example here, there was no upside follow through. Another rally, no upside follow through, and so on. From a bearish point of view, it's been frustrating because of the fact that the dollar was getting hammered against all the other major currencies except the yen. Now, part of the reason for that is obviously because the yen is a safe haven currency, and there was not much demand for the safe haven Japanese yen during most of 2020, since March 2020, in fact. So that's why the dollar yen was struggling to fall as sharply as the other dollar pairs were, as sharply as the dollar was falling against other major currencies. But ultimately, the trend is bearish on this market as well, okay? Because you can see that the slope of the 200-day moving averages is pointing down. Likewise, the 21-day exponential is pointing down. Prices make lower lows, lower highs. And we are seeing that bullish looking price candles like this one is they're continuing to fail breakout traders looking to buy above the high of those bullish looking candles. Each time you print a bullish candle, it fails. And so the path of least resistance for that reason remains to the downside. And this area here is a key area of resistance, previously support at 103.17. Let's call it 103.15 to 103.25-ish. That level was retested after yesterday's rebound, and that's where the selling has resumed from. So as things stand, it looks like the dollar yen is going to possibly head down and take out the low that was hit in March of 2020. That's where the big stop orders from people who bought this thing is likely to rest. So as we get closer to this level, I think we're going to see an accelerated move down to it. And then if we get really close here, then I think it's going to break down sharply, and we're going to head down to the next psychological level of 100, from where we may see a short-term bounce. But ultimately, the bearish trend, the trend is bearish, and I think it's going to go down from here. Make sense? So the dollar's weakening, which means things that are priced in the dollar should be rising. For example, gold. Well, gold is rising, as you can see right here. This is the daily chart of gold. This green level right here is the 2011 record high, or it was a record high back then. If I zoom out here, you can see it. This was the high that was hit in 2011. And we went above this level last year in July, before gold came back down to retest it a few times before breaking down. And then it struggled to hold the break above it once it tried to reclaim that level, and it went down again. So what I'm looking for now is, well, obviously the trend is clearly bullish at the moment. What I'm really looking for now is for this level to break at 1965.55. So that level breaks, we will have created our first higher high after this ugly looking price action. Okay, so that level is approaching. I think we're going to get there, hopefully, or probably. I shouldn't say hopefully, because some of you might be short gold and you'd be like, why are you saying hopefully? So let me rephrase that. From a bullish point of view, hopefully we'll get there today. 1965.55 was the last high prior to the last downward move. So if you go above that, we will have created our first higher high. That level breaks, then it's anyone gets as to how far this thing could go. And if you look at Bitcoin, I know a lot of people are making comparisons between Bitcoin and gold. Gold could do what Bitcoin did in terms of staging, doubling or tripling or quadrupling even in 2000 since 2020, since March 2020 low. Gold could literally do something similar. I don't think it's going to rise as significantly as Bitcoin did, because Bitcoin supply is limited to 21 million Bitcoins. Excuse me. Whereas gold supply, is obviously no one knows the exact supply of gold, but it will be very difficult for gold to do what Bitcoin did, because of the fact that the supply of gold is not known. In any event, I do think that gold is going to go higher over time, because, well, there are several reasons why I think gold is going to go higher from a macro point of view. But the main reasons are, ongoing central bank support. Interest rates are depressed across the global economy for the last 10, or 12, or even longer years. And there seems to be no end in terms of QE and money printing. So all of that cheap supply of central bank money and government stimulus is finding its way into, obviously they've been finding their way into the stock markets, but now people are looking elsewhere. And in recent years, gold and silver, especially gold, has been has benefited from that cheap supply of money. And now I think after a period of consolidation, the market has decided that it wants to go higher, because gold has broken above this trend line and outside of this consolidation. Silver is looking even more interesting to me than gold, because, oh my God, if you look at silver in terms of historical charts, it looks so bullish to me. This is a monthly chart of silver, and when it did this in 2020, I really wanted to see how far it will pull back, and I wanted to kind of to see a shallow pullback rather than a deep pullback to this gray area, because that gray area is where is kind of the point of origin of the breakout, right? So a lot of people will have wanted silver to go back all the way down here. I didn't want to see that, because if silver were to go back all the way there, it would have indicated to me that the trend is no longer as bullish as it once was. Why has it given back more than half of its gains, if it were to get there? But it didn't get there, and instead it found support around the relatively shallow 38.2% Fibonacci retracement, which is important, right? It's important because the shallow retracement suggests that most people who bought here, the bulls, they remained in control despite this sizable drop. In other words, the drop was more kind of driven by profit taking from the longs rather than people shorting this market, looking for a crash. So for that reason, I wanted to see the 38.2 hold, and for silver to go back above the August low, which it has now done so. And now that it's broken this short-term bearish trend line, it has broken out of this consolidation phase to the upside, which therefore means that from here, I think as a minimum, I'd expect silver to take out the high from last year, but potentially go a lot higher, because if you zoom out, silver almost got to 50. I think it got to 50. Did it? No, it didn't. It almost got to $50 back in 2011 before it crashed. I think silver is going to go towards those levels again over time. Part of the reason is, for me, it's obviously not just technical, but fundamentally, there's a drive towards cleaner energy right now, and silver is used in so for that reason, I think it's gonna so that's my view on silver. And let's have a look at the daily chart very quickly. Silver broke 26, which was previously resistance. It's now taken out 27. So from here, it looks like there's nothing significant in terms of resistance until $30 handle. But my invalidation level now would be this low here. Let's have a look. This low, right? So that was the low formed after the recent kind of mini sell-off, and it was the last low. So if we go below that, we will have created our first lower low. We don't want to see that, obviously, if you're bullish on silver. Okay, guys, I have run out of time. It has been just over half an hour since I've been speaking. So I can't see any questions either. Thank you so much for joining me. And I will be back later this week on Friday to present the non-farm payrolls webinar. But this particular webinar will be repeated next Tuesday, same time. So please join me again then. Take care and all the best in this first week of 2021. Speak to you soon. Bye.